All right, so we had a very interesting move today. Obviously, at the start, put a lot of pressure on things, fueled by a significant drop in Bitcoin. Still a Fibonacci drop, but that just shows how unbelievable the move was that preceded this retracement in Bitcoin. You go up 500%, you better be ready for a bigger than normal drop. That's the run that Bitcoin is on. The intermediate run is on a 500% rally. So you're going to get some steeper than what you are comfortable with drops if you're chasing that kind of return. On one hand. On the other hand, we had a really good intraday rally that filled in the gap this morning. So which one? Which one takes the precedent? And we're going to talk about, like what that means, what we expect. Is this bullish move? Is this a type of move that can lead us up? A lot of talking heads today were talking about, we're done. Like this was it. This was the end of the correction. We're ready to get going again, fueled higher by these tech stocks. So I'm going to break that down in today's video. We're going to take a look at a trade idea of a stock that's been on its own run, but has been grinding into resistance. And we'll talk about how to trade that given this broader market posture. So let's go ahead and get started. Today is Wednesday, May the 19th, 2021. This is the Market Outlook from MarketScholars.com. My name is David Settle. All right, let's start off taking a look at the S&P 500 with the market forecast indicator. As you can see, we're still not quite, we're still pretty darn noisy as we're trading between the 0 and 23% retracement levels. I had to remind my class today in our trading room that we had at Market Scholars that when you're below the moving average, that's when you have your biggest down and up moves, right? And so even if the up moves are intraday, like we had today, today's move was an intraday up move, pretty strong. But that's how it works. You have your biggest moves to the downside and your biggest moves to the upside, all when you're below that moving average. As you can see, the lower shadow here, which is typically bullish, when you've had an intermediate decline. I mean, that's the issue. There's a lot of chatter today about that hammer, a lot of chatter, especially on Bitcoin. But keep in mind that we haven't had an intermediate pullback here. There's not much of a decline to actually hammer out. There's not much of a bottom here to hammer out. As you can see, the intermediate line is not up in the bullish territory anymore, but it's also not even in the lower half of the chart yet. And you can see the we've been having some pretty bearish momentum lines down here at the bottom, and they haven't really been followed up yet with a good bullish momentum line to the upside, or having the near-term line get up to the upside either. But you also notice the near-term line hasn't really dropped below 20, which is typical when you are in a bearish decline. You can see even over here, just barely dropped below 20, but over there you can see how it drops into the lower half of the chart and stays there for a while. All these other bullish times, it drops into the lower half of the chart or low bearish territory and jumps right back up. So last time it stayed a few days. Now we'll see how long it stays down, and we'll see if that momentum line can actually bounce up to a strong level or not. So obviously I don't think that we will, because I still think that we have some more downside this week left to go. There's the intermediate decline that we are getting on the NASDAQ. You see its intermediate line is down below 50 and well below, into the bearish territory there. And as I've told you before, if I use the same Fibonacci lines, it actually did have an intermediate pullback here. But if we use the same Fibonacci lines that we did on the SPX, it has broken the 23% retracement level, and today's move did not get us back up above it, even if we got a weak bullish posture. You notice the intermediate line, turned up, but it's not anywhere close to getting up above 40 yet, and you can see the momentum lines again getting to extreme lows and not following up with good bullish moves to the upside. And the same thing with your near-term line, not really getting strongly bullish, not really getting too bearish either. So that's the NASDAQ. Now, the Russell is a little different story. The Russell actually did have a pretty good near-term run. And if I use the Fibonacci lines on its intermediate run, which has started a little earlier than the NASDAQs and the S&Ps, which started right there, the Russell started earlier. You can see, again, it's been flirting with its 23% retracement level. The intermediate line is down below 40, very strongly below 40, but looks to be getting back up above it, getting out of it. If we follow this near-term move up with a good bullish low point and we bounce off of here. Of course, I don't think that's the case, but you can see that the Russell's a little bit more bullish. Last week's little rally was stronger on a relative basis, and they got a good near-term sentiment that you didn't see on the NASDAQ, which only got to right there on the near-term level, or on SPX, which only got, which got close to 80, but right there, and you can see its market sentiment line still hasn't quite, can't have a correction without your market sentiment line still being above 80 the entire time. Obviously not the case for the NASDAQ 100. The intermediate line is still in bullish territory, so you can see it hasn't really had its correction yet either. And then, of course, the Russell 2000, its intermediate market sentiment line now has fallen through out of the bullish territory here up above 60, which again suggests that we might have some more, the downside still yet to come and can get pretty ugly on the Russell compared to some of the other indexes where it might not be nearly as ugly. Before we look at some other charts, I invite you to subscribe to our YouTube channel. Mouse over this icon here in the bottom right corner of your screen. Hit the red subscribe button that pops out. There's also one down below the video if you're watching us on YouTube with a bell next to it. Click on those. That will notify you when our videos are posted. Also, while you're down there, hit that thumbs up icon. That tells us that you liked our video today and that you want us to do another video again tomorrow. Quick way to give us feedback if you like our videos. Of course, if you don't like our videos, you don't have to click on anything. You don't even have to watch. But if you do like our videos and want to let us know, you can do it right now even while you're watching with one click. Also, comment down there. What did you get out of our videos today? What stood out to you? What questions or comments do you have? Why should others watch that are coming for the first time when they check the comment section? Post that in the comment section below. Join our website at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there, at DavidSettle42. And join our Market Outlook Facebook group that we've created. All right, if you're watching us on our blog, check out some of the other things over here on the right. Here's our Market Outlook live videos and our trading rooms. All of our paid subscribers get access to all of those videos, whether you're our monthly subscribers or our premium subscribers. Of course, our premium get all the access cheaper on a per month basis. But in addition to that, you also get access to our premium tools and resources, as well as premium access to our community, to our individual class forums where our custom content is. And also you get the Q&A sessions that with premium that you don't get with the monthly plus subscription. Come down here, click on this heart. It opens up a new tab. Hit that like button right there. Also click on this thumbs up icon. It opens up another new tab. Click on that like button there as well. Again, the more you do that, it really helps us out because more people actually see our content. You can see kind of, very few people actually see it. But the more engagements there are, which include the likes, the more Facebook will push our content to the people who actually follow us. Same thing with Twitter. It also benefits you because Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to kind of get in the habit of engaging with us every day here on the Market Outlook page. All right, now let's go take a look at the charts here today. And let's take a look at the 3 green arrow charts for SPY. As you can see, we did get a little bit of a green arrow here today on the stochastics with a really big jump in volume there. We're going to talk about that here in a minute. If you take a look at the 2-line version of this chart, though, we're still below both their respective moving averages, and they're still, here we're still below 40 on the actual MACD. The moving average is almost below 40. The MACD itself is below 0. The moving average is almost below 0. We're still below easily, even with the rally today, we're still easily below the 8-day moving average. So it kind of puts into context this rally. Again, the further you get away from the 8-day especially, the bigger the moves are. To just get back up to it, but it doesn't mean we have to cross it. So that's the kind of rally we had today. But if you also look at like some of these other indicators like the RSI and the CCI, like we're still below negative 100. We're still in the lower half of the chart on the RSI. If you look at the directional movement index, we're back above 30. We're back below 20. That's a bearish breakout pattern. You can see the dark pink shading from the market forecast there. You look at the Ichimoku cloud. The new bullish move that we're getting is petering out already. When it was weak to begin with, and it's already starting to peter out there. You look at the Bollinger Band width. We are in the lower half of the middle, right? We're at the very, very bottom of the middle, but in that lower half of the middle range, which means we're below the moving average, flirting with being back into the lower quartile again, which is what happens when we're bearish. So I mean, after one little jump back above the moving average, we're right back into that middle, the lower middle, which is more bearish. And when you're in a bullish trend, you will stay in the top middle. When you're in a bearish move, you'll stay in the bottom middle. Let me show you a little bit more perspective here. So here's more of a bearish intermediate pullback right there. You can see we stayed in the bottom middle the entire time. Here's a little bit more of an intermediate pullback right there. We're in the bottom middle, flirting with the top in the bottom middle. Same thing right there too. Over here, when we were, that's the COVID low, but when you look at like these two pullbacks, you can see, you know, for the most part, we were in the lower quartile. We were in the bottom middle, lower quartile, bottom middle, until we broke out. We were in the lower quartile, bottom middle, a couple little bullish moves trying to get going. But you see how, you know, when you're bearish, you're in the lower quartile and the bottom middle, and that's kind of what we've been flirting with right now. Lower quartile, bottom middle. So we're not really, we got a very significant resistance above us here. Now that we're below it, a very significant resistance of volume up above us. So it's going to limit any upside moves that we get on this. When we look at the intraday chart, you can see, you know, we gapped down, we filled in that gap. So, you know, that happens. When you get most of your move overnight, that happens. We had a really good battle early. Once we started to fill in the gap, then we knew that that was a common gap. Had we finished this battle to the downside, then we're looking at a runaway gap that won't get filled for a while. And we talked about that one, but that got filled in too, so that's not really a runaway gap. For the Qs, you can see on that Tuesday right there, you can see how we filled that in right away. So that's why, you know, good chance that that was not a runaway gap there, and eventually we filled it in there and there. So we still haven't really gotten that bearish runaway gap where we start off with a pretty significant gap down like we did today, like we did last week, but then finish down, right, with a move straight off of that. That's usually the kind of moves that start us off on those kind of declines, and we haven't had that yet, right? We haven't had that on this particular pullback move. If you take a look at the volume and the trading range today, you see the volume 106 million, the trading range there at 5.72, but you also have to account for the gap. So we close at 411.94, the high at 411.05, so about another point of a gap there that we didn't fill in by the end of the day. So add that to the range. So we had about 6 3/4 point range, almost 7. So when you put that move into context, here is 6 3/4, almost 7. So, you know, in 100 million. Now, what did I tell you last week? Like, you know, getting the big moves, the big volume, the extreme volume that was off the chart, and the extreme range that was off the chart on Wednesday, that kind of move, when they're extremes, they tend to, you know, bounce right back up. And we saw that Thursday and Friday. But now we're getting volumes that are above the moving average, above these lines, bringing them up, but they're not extreme. And what I told you that, I believe, on Monday's video, maybe Friday's, that's the kind of volume that's more bear. That's a sustainable bearish volume. That's a sustainable bearish range, because now they're still above these lines. We'll get these lines going up, but not so extreme that we just snap back so quickly. So I don't think that we'll snap back so quickly today. I think we already had our snapback intraday, and now we'll most likely move our way more to the downside. You can see the volatility index. We talked about at our class last week that, you know, yesterday, at the end of the class yesterday, right over here, that this is the low point for volatility, sitting right on the 85% line. As we saw it bounce back up, it pulled back down, but I don't expect it to get back down to 85 or below that. I think now we're just higher high, higher low until we break out into the 100 to 105% mark, which, like I said, typically starts the beginning of an intermediate pullback. And if it gets up to 115, then it'll be the start of more of a market sentiment decline, which doesn't necessarily mean it's a little bit deeper. We've talked about how much and where, and when you look at the market forecast chart, we talked about an intermediate decline will probably get us into this area at worst, 37.57, whereas a market sentiment decline would get us down to 34.50. Again, most likely at worst, maybe a little bit lower on the intraday basis, but that's probably about as low as it gets. Then the issue is, how long will it take to get a new intermediate run started, and that's what takes a while. So you can see that's, you know, when you look back from a timing standpoint, how long it takes an intermediate run, it didn't take that long. But if you notice the market sentiment rally, it took a couple of months there. This one is more of a market sentiment rally, and it took 4 months to get going again. Same thing over here. This was a market sentiment decline. It took about 3 months to get going again. Those are both relatively short time frames for market sentiment declines over here too. This one as well was a market sentiment decline. To see how long it takes before you get a new set of dark green shading and a green line. Whereas intermediate rallies, you can see they're quick. Maybe a month, maybe two, but that's how long it takes before you get the next set of dark green dark green shading and green lines. So if we do ultimately get down into this area, it might be 3 to 4 months before we finally get the next set of dark green shading and green line, and we get back up above this 23% line here and get going again on a new long-term market sentiment run. So I know there's a lot of chatter today about the hammers and this is it, and now we buy this dip and we get going again, and here we go, and tech sentiment is really low and everything is set up for like a bounce right now, that the correction is over. The correction in tech stocks, at least. The problem is we haven't had a broader exhale. We haven't had a broader correction across all risk asset classes like we're seeing right now in the most speculative ones. It hasn't bled out into other areas, especially in the small cap area, which has a lot of room for an exhale to occur, and very, very poor margin of safety that we haven't experienced yet. So I'm a little different today because we look at the same things every single day, and as we saw, 4% declines, as I showed you before, doesn't necessarily constitute a full correction. Maybe if you're coming off of a 10% rally, but not when you're coming off of a 89% rally. So I still think even with today's move, we tend to get bigger moves and to the upside and to the downside when you're below moving averages like we are. I expect that will continue to be the case, but I think that the bigger move to the upside occurred today, intraday, and now we'll probably finish the week more to the downside. And again, I could be wrong, but wouldn't be the first time. But that's what I'm expecting going into the end of the week. What do you think? Do you agree do you disagree with that? Let me know in the comment section below, especially if you disagree. What chart or indicators are you looking at that you look at, time and over and over and over again, that are telling you why you're either a lot more bullish or a lot more bearish than I am right now. All right, now let's get back and talk about what's driving this moves. As we saw with Bitcoin, that's the biggest one right now. I think, and in fact, let's take a look at that chart. I think Bitcoin is a really good reflection right now of overall risk for speculative trades. Obviously, we had a rally, and we talked about this before. We had a rally of about 500%, 500% there during that 6-month period from whenever that would be, from the when was this? When we really started going, we got going over here when we started the intermediate run. So that would be in the middle of October to this peak over here of middle of April. So about 6-month rally, a 500% return in 6 months. That is quite the move to the upside. Even with the move even at the lows today, we were still 200%. That's why there's such wide gaps down here, because it's a log scale between the 78 and 100, which is a much bigger gap than the 0 to 23, which should be about equal. But because it had moved so much, it's not equal. And that's why, we've had a really good drop to the downside, but you notice it's only a 50% drop of what we previously had rallied. We still have really good returns even up to the low point, which you notice got to the 62% retracement level. Normal, deeper in the normal range, but deeper in the normal range. Because again, 38 to 62 is normal pullbacks. Anything beyond that starts to get pretty abnormal. Anything less than that is abnormal on the weak side. So 38 to 62 is kind of your normal range. And of course, if it gets below 78, now we're not retracing anymore. Now the retracement's done, and we're starting something different. But I also noticed too, and I talked about this on Twitter, that long lower shadow, this is a very bullish candle that would be confirmed if we get back up above this candle. So essentially, if we get back above this 38% retracement level, then we'll have some pretty decent confirmation that that this hammer is played out and we're back to being bullish, right? That the bullish candle is doing its thing, because that's really bullish, long lower shadow. But absent that confirmation, then it's very easy for us to trade inside the range of a long lower shadow using the low point as a closing support level. So don't be surprised, unless we break up above 45,000 tomorrow, which is probably unlikely. But unless we do, don't be surprised if we don't more slowly start to fill in that range with a few candles and start threatening that low point. Now, there's going to be some pretty decent support in this area, but that will, again, be more of a broader, be a reflection of speculation kind of coming out of the markets. I've shown you this chart before, but it's the gamma exposure chart. You notice it's been gradually getting lower and lower and lower as call buying starts to decrease. It's been decreasing pretty much all year long. This is where the beginning of the year was right here. So you notice we've been decreasing, absent that little spike right there, we've been decreasing our call buying all year long in 2021. That's what's led to the put-call ratio rising since 2020. Even with the VIX higher, which represents put buying, call buying has been so significant to the downside, and that's really also impacted the trend, which you notice continues to be relatively low, but spiked up today. 1.88, that's a very, very high level of trend, with trend being below 1 and getting the 20-day average back above 1. Again, that suggests that is more bearish, right? And a rising trend would be more bearish after you peak like this, coming from low levels with such a high number. So that's why I'm not too sold on the selling, on the snapback today being bullish. In fact, I think more the snapback today was more, okay, now we can sell that. They'll fade this rally, which is all intraday, but fade this rally into, like I said, the end of the week. With the rotations, which we'll talk about here in a second, showing that we're shifting in that direction. If you look at today's move, you can see, and if I just, first of all, for the week, look at energy, which was very strong on Monday, and then look at the move it's had since. So it's been very weak ever since. In fact, today's move, if I just look at today alone, energy had the biggest loss, was down 3.5% at one point. Materials was down. They finished down quite a bit. Industrials, financials down. Technology, discretionary it finished the day up, but they were down, just not as much as the broader market, as these other areas, which have had the biggest gains, are starting to roll over. And so when you look at now the 12 grid, remember those other areas have already been bearish, right? XLK, XLY, XLC, they're already dark pink shading in a red line. They're all in bearish intermediate mode right now. These others aren't. They're still all above their moving averages with dark light pink shading. So we still are in the early innings of any kind of intermediate decline that we may be getting right now. And if you look at it from this perspective, which I've been sharing with you a lot, this relative rotation graph, look at the daily chart now for energy, materials, financials, industrials. Look how they're moving down to the right. XLU, there's XLU, there's XLP, there's XLV, XLRE. These are your safe haven areas, all showing stronger relative strength in XLK, XLY, XLC. And then look at the long-term trend. So they are really headed down. Energy, financials, materials, industrials, XLU, XLP, XLV, XLRE, they're all moving up to the right. So we are rotating on a long-term basis into bearish mode, and we are just starting on a daily basis to lose that momentum. When you look at like XLE here on this chart, you can see, oops, sorry. Let's try this one more time. XLE. You can see that it's just, it's got negative momentum now. It's just starting to roll over from a very high relative strength level. You look at XLB, it's been very strong too. It's just starting to roll over the MACD here. Let's go to this is on the weekly chart. Sorry, let's look at the daily chart. So here's the daily chart. You can see the relative strength just starting to roll over with falling momentum. Let's show that XLE again. Just starting to roll over momentum, and the peak there, the XLI, just starting to roll over on its relative strength line with falling momentum. And then XLF, same thing. right? Whereas on the flip side of the equation, XLU, that's had some pretty decent relative strength, but it's had some falling momentum on the daily. But look at the weekly, right? It's still, it's just getting going on the weekly basis. The relative strength is almost about to cross up above 100. XLP relative strength is almost about to cross above 100 with positive momentum. And then, of course, XLRE already had because it's been outperforming. So you can see how the safety trade is coming more and more in line on the long-term level as we start this rotation here. So don't be surprised if we start to see more dark pink shading and red lines in other areas that had previously been so strong. So for our trade idea of the day, I wanted to take a look at Lockheed Martin. Lockheed Martin, you can see, has been pulling back in the last couple of days, like just about everybody else. Had a really good bullish run going here, but you see how it's been converging. It's been petering out right at some important resistance levels. If you look at it on a 2-year basis, right at these last fall levels, and it's been unable to get going. You can see the intermediate line now is dropping almost below 60 here, so we're not as bullish anymore. In fact, if you look at the directional movement index, it has kind of lost the bullishness that it had, right? We were below 20 in the negative indicator, and we popped back up. This time, at the same time it popped back up, the positive indicator has dropped below 25. So the ADX is falling. We're really kind of grinding with that resistance level there. You take a look at the 3 green arrow chart for Lockheed, and you can see we're flirting with that 17-day moving average. You notice we're below both moving averages that are both falling from lower levels. Some divergences showing up there, as well as on the RSI and the CCI. Some really significant divergences on the, that's the SPX. Let's look at Lockheed. There's a significant divergence showing up on Lockheed going into that peak. So we're really kind of rolling over and getting into lower levels. The trend that we were on has been broken according to this from very noisy levels. We're below that green line, kind of flirting. You can see the red line is also flirting with price staying below price, which is also bearish. And then finally, from a Bollinger Band perspective, if I look at especially on a 2-year chart, you can see just how significant this resistance is. That's now up above us, right? We are flirting with that point of control there. Big volume up here at the top of the value areas up above these levels. So it doesn't mean we can't break out, but more than likely you expect resistance to hold until it doesn't. And so that's kind of what I'm looking at. I'm not looking for we haven't broken down, so I'm not looking for a directional move to the downside, but I'm looking for that 390 level to hold. So I'm going to sell a call there at 390 and protect it with this long 395 call option. So this is what it looks like on the chart. I make my money if we stay down below 390, and then I lose if we go back up. And again, I'm trying to make 450. So out of the 1,050, I'm position size for. I'm only willing to lose 450, like how much I'm trying to make. So that's when I'll try to get out early. So you can see, like as of right now, that would mean to move up towards 400, which would be a breakout, right? We'd be definitely breaking out if we get to 400 and we'd close that trade, take the loss, and move on to something else at that point. But again, considering the broader market posture, I wouldn't expect that to happen, especially with that very strong level of volume resistance that's in this area. Of course, nothing's 100%, but the probabilities would be lower, hence the trade that we're making here. Alright, so that wraps us up for today. You've heard from me now. Now I want to hear from you. Use that link that's popping out in the top right corner of your screen. That takes you to our Market Outlook forums. Remember, that's available for everybody, including our free subscribers. So let's open up any new thread with any questions or comments you have about anything we talked about today. Reply to anybody else's threads, and let's keep this conversation going among our Market Scholars community here in between the videos. As always, thank you very much for watching. Remember to click that, subscribe to our YouTube channel, click that thumbs up icon, as well as like us on Twitter and Facebook, and comment on the video. Have a great rest of your Wednesday night, everybody, and we'll see you all next time.